Best Small Business Loans with Bad Credit by avibusinesssolutions.com. Cash flow problems rarely wait for your credit score to improve. If you are searching for the best small business loans with bad credit, the real question is not just where to apply. Which type of funding gives your business enough speed, flexibility, and approval odds without creating a repayment problem next month? Bad credit does not automatically shut the door on business funding. It does change the playing field. Traditional banks usually want strong personal credit, years in business, and clean financials. Alternative lenders, revenue-based financing providers, and some business line of credit programs focus more on sales volume, cash flow consistency, time in business, and the strength of the opportunity in front of you. That difference matters. A business owner with a 580 credit score and steady monthly deposits may have more financing options than an owner with a higher score but inconsistent revenue. The best fit depends on why you need the money, how fast you need it, and what your business can realistically afford. What counts as the best small business loans with bad credit? The best small business loans for bad credit are not always the cheapest on the market because those tend to go to borrowers with excellent credit. The best option is usually the one that balances approval speed, total cost, repayment structure, and the amount of pressure it puts on your cash flow. For example, a short-term working capital loan can help you cover payroll, inventory, or urgent repairs quickly. That speed can be valuable if a delay would cost you sales. But if the repayment schedule is aggressive, the loan may solve one problem and create another. On the other hand, a business line of credit may be harder to qualify for than a basic revenue advance, but it can offer more control because you draw only what you need. This is why business owners should think beyond the phrase bad credit loans. The better lens is usable capital. You want funding that helps you move forward, not financing that keeps your business stuck in repayment mode. The loan types worth considering are short-term business loans. Short-term loans are common for owners who need capital fast and may not qualify for bank financing. These loans are often used for emergency expenses, seasonal inventory, marketing campaigns, equipment repairs, or filling a temporary revenue gap. Approval can be based heavily on revenue and bank activity rather than solely on credit. That makes them accessible, but at a cost. Rates and fees are often higher and repayment periods are shorter. If your margins are tight, that matters. Business lines of credit. A business line of credit gives you access to a set borrowing limit and you draw funds as needed. This can be a strong option if your expenses come in waves or you need a buffer for operating costs. For bad credit borrowers, a line of credit can be harder to secure than a basic short-term loan, but it is often more flexible. You are not forced to take a lump sum you do not need. That can reduce borrowing costs and make day-to-day cash flow
Running a small
easier to
business means
manage.
being ready for
Merchant cash
anything. But what
advances.
happens when
This
the big
option
banks
is
say
often
no?
available to
At
businesses that
AVI
accept
Business
card
Solutions,
payments,
we
such as
say
restaurants,
yes.
retail stores, salons, and service merchants. Funding is usually based on revenue performance, and repayment is tied to future sales or daily withdrawals. The upside is accessibility and speed. The downside is cost. Merchant cash advances can be expensive, and daily repayments can squeeze working capital if sales slow. They make the most sense when the return on the money is clear and immediate. Equipment financing. If you need machinery, vehicles, tools, or specialized business equipment financing may be easier to get than an unsecured loan. That is because the equipment itself helps support the deal. This can be useful for business owners with weaker credit who still need to upgrade operations. The catch is simple. This funding is purpose-specific, is not the best option for payroll, rent, or broader working capital needs. Invoice financing. For B2B businesses that bill clients and wait weeks or months to get paid, invoice financing can free up cash tied to receivables. Lenders may focus more on the quality of your invoices and customers than on your personal credit score. This can work well for staffing firms, contractors, distributors, and service companies. Is less useful if your business does not operate on invoices or if your customers have weak payment histories. How lenders evaluate bad credit borrowers. Credit score still matters, but is only one piece of the file. Many non-bank lenders look at monthly revenue, average daily bank balance, time in business, industry type, recent NSF activity, existing debt obligations, and whether your deposits are stable. That means there are practical ways to improve approval odds even if your score is low. Clean up your business bank statements. Reduce overdrafts if possible. Keep deposits flowing into one primary account. Know your monthly revenue average. If your numbers are easy to verify, you become easier to fund. Lenders also pay attention to risk by industry. A business with recurring revenue or predictable customer demand may be viewed more favorably than one with irregular income. If your business is growing, be ready to show it clearly. How to compare offers without wasting time. When business owners are under pressure, they often focus only on how much they can get and how fast it can arrive. Speed matters, but cost structure matters just as much. Look at the total payback, not just the funded amount. A $30,000 offer that requires $42,000 in repayment is very different from a $30,000 offer with a lower total obligation. Ask how often payments are made. Daily payments can
Running
feel
a small
manageable on
business means
paper,
being ready
but
for
become
anything.
difficult in a
But
slow
what
week.
happens when the big
You should
banks say
also
no?
ask whether there are
At
prepayment
AVI
benefits,
Business
renewal
Solutions,
options,
we
or
say
additional
yes.
fees. Some financing products reward early payoff. Others do not. Some are useful as a bridge to better funding later. Others are expensive dead ends. The best offer is often the one that fits your revenue rhythm. Weekly or monthly payments may be better for some businesses than daily withdrawals. A revolving line of credit may be better than a lump sum loan if your needs are ongoing but unpredictable. Red flags to avoid when looking for the best small business loans with bad credit. A lender that promises guaranteed approval without reviewing your business is a warning sign. So is vague pricing, pressure to sign immediately, or a refusal to clearly explain the total repayment. You should also be cautious if the repayment schedule seems disconnected from how your business actually earns money. Fast funding is valuable, but a bad structure can drain your account just as quickly as the money arrives. Another common mistake is borrowing too much because the offer is available. More capital is not always better. If your business only needs enough to cover inventory and launch a campaign, taking a much larger amount can increase repayment stress without improving results. When bad credit funding makes sense. Bad credit business funding makes sense when the money solves a real business problem with a measurable payoff. That could mean buying inventory with strong margins, repairing a critical asset, bridging payroll during a slow receivable cycle, or funding a marketing push with reliable conversion history. It makes less sense when the business is already underwater and the new funding has no clear path to generating revenue or stabilizing operations. Financing should support momentum, not mask a deeper issue for a few more weeks. That is where a practical funding strategy matters. Sometimes the right move is a smaller loan now, followed by improved statements and a better product later. Sometimes a line of credit is better than a fixed loan. Sometimes invoice-based funding beats unsecured capital because it matches how the business gets paid. A solutions-focused provider, like AVI Business Solutions, can help business owners view these options through the lens that matters most: access to usable capital without unnecessary friction. What to do before you apply. Get your last few months of business bank statements ready. Know your average monthly revenue, your current debt payments, and the exact amount you need. Be specific about how funds will be used. Lenders respond better when the purpose is clear and the amount makes sense. It also helps to separate urgent needs from ideal needs. If you need $18,000 to cover immediate inventory and another $10,000
Running
for
a
future
small
upgrades,
business means being
those
ready
are
for
two
anything.
different conversations.
But what happens when the
Clarity
big banks say
improves
no?
both approval
At
odds and
AVI
decision
Business
making.
Solutions,
If
we
your
say
credit
yes.
is weak, let your business performance carry more weight. Strong deposits, stable operations, and a practical funding request can go a long way. The right loan is not the one with the biggest headline promise, is the one that gets your business moving today without slowing it down tomorrow.
Running a small business means being ready for anything. But what happens when the big banks say no? At AVI Business Solutions, we say yes.